Okay. So now we're going to talk about unearned revenues and how you do the entries for that. We're going to be looking at the same problem we just did, but we're going to be looking from the other side of the problem for the seller of insurance. And that will be the sample problem that we'll do in order to look at that one. So unearned revenue. This is where we get cash before we actually earn the revenue. So we might see this in rent or magazine subscriptions, customer deposits, airline tickets. A real common one you see this is like if people buy sporting events, they buy season tickets. You know, if they pay for season tickets up front, the team that they're buying, say the 49ers, right, they would not recognize all that income right then. They would do an entry every single time they play a game in order to recognize how much they earned for each game, okay? So when you do the adjusting entry for unearned revenues, this is important that you will want to note, you are going to debit a liability, which will decrease it, and you're going to credit a revenue, which will increase that. So the adjusting entry for unearned revenues is to debit a liability and credit a revenue. So make a note of that. The adjusting entry for unearned revenues is to debit a liability and credit a revenue. Okay. So we'll look at a sample here. Sierra Corporation received $1,200 on October 2nd from R. Knox. The guide services for multi-day trips executed, for guide services for multi-day trips expected to be completed by December 31. Unearned service revenue shows a balance of $1,200 in the October 31st trial balance. From an evaluation of the service Sierra performed for Knox during October, the company determines it has earned $400 in October. So in order to show what they've earned, they're going to debit the liability, unearned service revenue. And it's a liability because if they never provide the service, they have to give that money back. They're liable to give it back, right? So they're going to debit unearned service revenue, $400, and they're going to credit service revenue, $400. So you will see an entry like this at some point. Okay. You will see an entry like this at some point. So the entry for unearned service revenue is to debit unearned service revenue. And this one they told you it was $400. And we're going to credit service revenue $400. Okay. All right. So here's examples of unearned service revenue. We have rent, magazine subscriptions, customer deposits for future service, tickets for events, plane tickets, hotel reservations, things like that, things that you're paying for in advance that you haven't used up yet. I wouldn't worry about the reason for adjustment right now or the accounts before or after, but I would remember that the adjusting entry is to debit a liability, which is going to be unearned revenue, and credit the revenue. Okay. All right. So we are going to do one of these together as a sample. Okay, so we're going to do BE 48 on 44 on page 444. So I'm going to put that over here and let me share my screen for that. I got to scroll down. This. I'm going to share this with you. Stop sharing that. Share the Excel. Okay, there we go. Okay, so BE 48 says, using the data in BE 47, so that's the problem up above, journalize and post the entry on July 1 and the adjusting entry on December 31 for Marsh Insurance Company. Marsh uses the accounts unearned service revenue and service revenue. Now this is important because remember in the ages ago I said to you, you always ask, who am I? In this problem, who am I? Well, when we did this problem before with the entries from 4.7, right? We were Ling Company. We were the people that were buying the insurance. We were buying the insurance. We were Ling Company. We are now Marsh Company. Who's Marsh Company? If you go back and read entry 4.7, it says, on July 1, Ling Company pays $12,400 to Marsh Company for a 2-year insurance contract. So we are Marsh Company. We are the ones that are selling the insurance. Okay. So they want us to journalize and post the entry on July 1 and the adjusting entry. So we've already done all the math. That's all this over here, all the math that we did. Now we're going to do the entries. So on July 1, we're Marsh Company. What did we get? Well, we got cash. They gave us cash. How much cash did they give us? They gave us $12,400, right? But that cash was not earned. It was unearned service revenue, which has a credit balance. So we're going to credit that 12,400 to make it go up. And that means that if Ling Company was to cancel their insurance policy the next day, we'd have to give them back the 12,400. We'd be liable to give it back. And we're not talking about return charges or anything like that, anything like that. We're just talking about if it was just a straight 1-for-1, right? So it's a liability until we provide the service to earn that money, okay? So the December 31, now we're going to recognize how much we have earned. We already know how much we've earned because we did it up here, right? So we sold a policy for $12,400. We're going to multiply that by something over 24 because the $12,400 was for a 24-month policy. And we know it's 6 months because we sold it on July 1 and we're doing our entry on December 31. So it's all of July, August, September, October, November, December, 6 months. So 624 turns to 0.25 is the fraction, so 3,100. So it's the same numbers that we used for the other company, okay? But they were the buyer, now we're the seller. So on December 31, we are going to debit unearned service revenue because we have now earned that money, okay? We've earned the money. So we're going to debit that $3,100 for the amount that we've earned. And we are going to credit service revenue to show that we've actually earned the money. Showing that we earned the money, okay? Now, to balance the T accounts, we're going to have one T account, unearned service revenue. And then we're going to have one T account for service revenue. So unearned, so let me see, we would debit cash, 12,400. We would then credit service revenue. On July 1, we would credit service revenue, 12,400. Unearned service revenue, 12,400, okay. Then on December 31, we would debit unearned service revenue, the amount we earned, which was 3,100. And we would credit service revenue, 3,100. So now we'd have to balance those accounts. So for service revenue, the balance on 12/31 would be 3,100 credit. And then for the unearned service revenue, we would subtract the 3,100 from the 12,400. So you subtract the smaller side from the bigger side. And we would have a balance in this account of $9,300. So $9,300 would be the balance of unearned service revenue that we still need to apply in service or to the customer. We still owe that to the customer in service.